Hello, everyone. For those of you in the room, I'm back. For those of you who are joining us on the live stream now, welcome. So welcome to all of you who are joining us from across Canada. So I'll introduce myself again. For those of you on the live stream, my name is Shannon Ward, and I'm the Chief Growth Officer here at Genus Capital Management. So I'll be your host today. In addition to myself, we also have some wonderful speakers with us. So first of all, I'll introduce Wayne Wachel, who is our Executive Chairperson and Chief Investment Officer. Stephanie Chu is our Chief Sustainability Officer. Justin Han is our Macro Analyst. And we have a new member of the team joining the lineup this year. Lisa Zhang is our Head of Equity Investments. And we're happy to also welcome Sebastian Rayom, all the way from Montreal. Joining us, he's a partner from Alpha Fix, who are our fixed income sub-advisor, so he'll be talking to us about the bond market. I'd like to acknowledge that today we're coming to you from the lands of the Musqueam, Squamish, and Tsleil-Waututh nations. We recognize their deep and enduring relationship with this land. Now, as you are probably aware, our purpose today is to review the key events of 2025, how they affected your portfolio, and to provide some insights as to what may be coming for 2026 and what our plan is for those elements. Couple of housekeeping items before we dig into the content. One is we're going to have a question and answer period at the end of the presentation. So if you have any questions, you might have them now, they might come to you as you're listening to the presentation. The easiest way for you to get those to us, particularly if you're online, is to use this QR code. You can just snap it with your smartphone, and that will take you to a website where you can submit those questions. Also, you can go to slido.com and then put in that hashtag, and it will take you to the same place. We will endeavor to get to as many questions as possible, and I just want to note now, if we don't get to all the questions, we will endeavor to answer those questions individually with you after the session. Also, anonymous submissions are welcome. You don't have to put your name to your question. The last thing is there will be a recording. So, we're gonna hit you with a lot of information today. And in case you don't take it completely all in today, you can also look at the recording, which will come to your inbox in the next few days, and it'll also be available on our website. So if you want to share it with friends and family or look at it again, you can do that there. I wanted to start here because as a wealth management company, our mission is to help our clients meet their financial goals in ways that reflect their personal values as well. And we work really hard to offer a variety of investment solutions spanning many asset classes, as you can see here, and with different areas of focus. So I wanted to show you the full breadth of our solution because it's actually quite broad. We've added a new commodity fund this year. We're continually adding to make sure that we have a variety of solutions for the diversity of clients that we have. When we say we meet our clients where our values are, that means that in this room today, there's a wide diversity of clients. And there's a wide diversity of perspectives that all of you bring, both here in the room and online. And our broad range of investment solutions also means that we're exposed to a broad range of challenges and opportunities. And so what that means for this session each year is that we have to narrow it down because we can't talk about everything. And this year was particularly difficult, as you can imagine, because there's so much to talk about. So what we did this year was we went to the portfolio managers and we asked them, what are the key topics that are coming up in your meetings with clients? What are the questions that they have? What are the things that are keeping them up at night? And then we focused down from there. So we focused it down to 5 themes that you'll see woven throughout today's presentation. And those are really the core themes that we're seeing coming from you, the clients. Now, if for some reason we don't cover one of the things that you really wanted to see covered, that's a great time to ask a question at the end, and then we can get the expert panel to answer that question at that point. So today we're going to do our best to provide as much information as we can on those key topics, answer your most burning questions so that you can leave today with more clarity and maybe even a little bit more peace about what's happening in the markets and what's happening in the world. So, what were the top themes? Let me reveal them. The first one, probably not a surprise to everyone, is artificial intelligence. I'm sure you've noticed as well as I have that the headlines have been dominated by AI this year. We see things like AI winners will drive the markets, AI-driven inflation is the most overlooked risk in 2026. So it's hard to know what to think when we see all of these headlines. But questions come up like, are we in an AI bubble? And if so, when will it burst? But then there's also the other side of it, the environmental effects of AI, the social effects of AI, and we need to deal with those questions as well. So there's a lot to cover here, and we're going to do our best to talk about how much we should listen to in the headlines and what the real-world data is actually telling us today. The next is inflation and interest rates. So of course, this continues to be top of mind for investors. We see headlines like inflation could reaccelerate. What if the rate cuts are delayed? What if they're reversed? And of course, to all of you and to me as an investor, that means, what does that mean for my borrowing costs? What does that mean for the bond market? What about my mortgage? So we'll dig into those issues throughout the presentation as well. This one's really interesting this year, values and concentration. So we're hearing things about bull markets. We're hearing things about bear markets. We hear lots about the Magnificent Seven, which is actually now the Magnificent Six, but I'll let Wayne tell you more about why that is. But the thing that really I think is on the mind of a lot of people is, these markets can't keep going up, can they? So today we're going to dig into that question and also the question of, should you be doing something different with your portfolio given what's going on? Is the pricing built in? Isn't it? All of this is happening on a backdrop of geopolitical volatility. We have tariffs, we have wars. Now we have the US trying to take over Greenland. It's really hard to keep up, and all of it affects your portfolios because it affects the markets. So today, Wayne is going to take on the rather gargantuan task of discussing in depth the key political issues that are happening, geopolitical issues that are happening, providing us context and clarity so that, again, we can move forward and make more clear-headed decisions as they relate to our investments. And lastly, we want to definitely talk about the ESG landscape. It's been quite a year in the ESG landscape. There's a lot of backlash that's been happening. Again, we see headlines like ESG funds are seeing record outflows. We see headlines about BlackRock or even Canadian wealth management firms getting targeted by the regulators over misleading ESG statements or greenwashing. We also see things like clean energy stocks beat fossil fuels despite ESG skepticism. So there's a lot to take in and a lot to understand. But for sustainable and impact-focused investors, what this all boils down to is, what does this mean for me? And what does this mean for my portfolio? So Stephanie, our Chief Sustainability Officer, is going to break down the current ESG landscape for us. She's going to separate the facts from the hype, and she's going to share what our plans are moving forward into 2026. The last thing that I want to leave you with is this. This is a chart that represents the returns for our Genus Global Balance Fund from 1989, which is the inception of the company, to today. So you'll see that the Genus Global Balance Fund is the orange line. The other funds are the market indices, the benchmarks. So the light blue one is the MSCI World Index, so that represents global equities. The black one is the S&P and TSX composite, which represents the Canadian equity markets. And then at the bottom, there's the gray, which is the Canadian bond market. So why am I showing you this? The reason is because this represents a medium risk asset mix. Now, some of you may have a more aggressive asset mix, some of you may have a more conservative asset mix, but this gives us a good starting point for a conversation. And what I wanted to note from this particular chart is that this chart illustrates that through multiple recessions, through market crises, booms, bubbles, regime shifts, that balance fund has gone up smoothly to the right. And so those delivered consistent returns for the clients. By the way, this is gross of all market fees. The other thing that occurs to me is that during all of this time, I'm sure there were many times, if we think back, that we thought they were unprecedented times, just like we're thinking they're unprecedented times now. And what matters most to our clients, and to us, therefore, isn't what happens in one market cycle. So that's what we really want to focus in on today. It's what happens across an investing lifetime. Our focus has always been consistency and resilience. We're not chasing short-term forecasts, and we're not chasing headlines. So the team is also going to take some time today to explain how we achieve this kind of consistency and what we plan to do to ensure that it continues for our clients. So with that, I'll start it off with Justin Hahn, our macro analyst.
Thanks, Shannon. So today I'll be going through what we saw during 2025 and what we expect going into 2026. Overall, we view 2025 as more of a recovery year where a lot of economies narrowly avoided a recession and still remained positive. 2026, we think, will be more of a transition year with the markets broadening out as well as a cyclical rebound. We think that the U.S. will lead this cyclical recovery just due to these four factors: interest rates, government spending, rise in AI spending, as well as improved trade balances with higher exports in the U.S. Firstly, looking at interest rates, we can see that central banks have been lowering interest rates since about mid-2024. What's important to note is that Canada is a bit more farther along in their cycle, which is the red line, along with Europe, which is the purple line, and the US still has room to fall, which is the blue line. This is due to Europe's more relatively stronger economy. In addition, it's important to note that interest rate effects usually take about 12 to 18 months to come into effect and filter through into the economy, so we expect these effects to come through in the second half of this year as well as beyond. On top of the low falling interest rates, we have seen that fiscal spending has increased, especially in the US. Even without new legislation, current tax measures are expected to boost US consumers as well as corporations. There's expected to be about $200 billion worth of tax cuts, which should help an already strong consumer base in the US in the second half of this year. On the corporate side, we do see continued spending as well. This chart illustrates that AI is not just a market story, but more of an economic one. AI-related spending just with the Magnificent Seven alone is expected to reach $500 billion. This should not only help the technology industries, but also the peripheral industries, such as industrials, which are helping build the infrastructure for these data centers, as well as utilities and energy, which is providing the energy for them. Finally, taking a look at the last stream of income for the US, we see that net exports tend to be an underappreciated value add for GDP. This is mainly because over the last decade, it has been a drag on growth for US. But we can see starting in after the tariffs were announced in the first quarter of last year, that is actually contributing to GDP. The blue bar here represents US GDP, and the orange bar represents how much of that GDP is contributed to net exports. US GDP expectations are supposed to reach 5.1% for the final quarter, and net exports should also contribute largely to that. Moving more on to inflation, we have seen interest rates fall and stabilize around that 2 to 3% level. Where over the last year, this is kind of the sweet spot for the markets where we're still getting growth, but it also still gives flexibility for central banks. There are several factors quietly doing the work for central banks. Firstly, it's higher unemployment rates, productivity boosts thanks to AI, along with deregulations helping reduce costs, and the most important factor, oil prices. None of these are dramatic on their own, but together they are having a meaningful impact to inflation rates. Both Canada and the US core inflation rates remain around that 2.5% mark after rapidly decelerating starting in 2023. While it is on the higher range of the 1 to 3% target that central banks are targeting, we think that this might be the new sweet spot to prevent causing a recession just to get to that 2% level. This was evident all last year with the Bank of Canada lowering interest rates despite core inflation rates at 2.5%. When it comes to the labor markets, a modest rise in unemployment rates isn't a sign of collapse. It's more of a sign of normalization. It reduces wage pressures and gives central banks more flexibility to adjust interest rates accordingly. Unemployment rates both in Canada and in the US have been falling, but have been rising slightly, but they're still around the pre-pandemic levels. On top of the stable unemployment rates, we are also seeing productivity increase mainly in the US. So productivity in the US has been on a rise since the 2000s, rising over 50% during that time. In Canada, however, it has been flat since about 2015. This is a period that we call the lost decade for Canada. It's not because Canadians are more lazy and not working as hard, it's more of a structural issue. Canada generally has a lot more regulations and our economy is more identified and described as an old economy, where a lot of the low productivity sectors such as banking, real estate, and construction reside, versus the US economy, which is more growth and service sector heavy, which tend to be a lot more productive. This is why Canadians are feeling a bit more squeezed and why GDP levels have, despite GDP levels increasing, the per capita numbers have been more relatively stable. Having a look at the last factor affecting inflation, energy prices is one of the most powerful macroeconomic variables. Lower oil prices reduces volatility, also directly helps consumers and lowers input costs for corporations. Oil has been on this steady downtrend starting about mid-2023, and we think that this trend will continue unless there's some permanent shocks to oil supply chains. Now that I've looked at all the positives heading into 2026, I'll be describing on one of the big risks that we're seeing heading into 2026 and onwards. The biggest potential risk we see in 2026 isn't a recession, it's more of a loss of confidence in government balance sheets. Although this is a very low probability, less than 5-10%, it's not something out of the question and something that we're watching closely. Typically what happens during this time is high levels of debt create government solvency issues. This causes the bond vigilantes return. Bond vigilantes are just market participants who sell government bonds in response to unsustainable fiscal policies as well as high inflation, and thus punishing governments and forcing yields and financing rates higher. These higher yields then create problems for banks and pensions, and then it filters into the rest of the markets, such as equities and real estate. Having a look at one of the more main indicators for this is the high yield market. We call the high yield debt market the canary in the coal mine for markets because of their inherent nature, and it's usually the first to move due to any uncertainty or heightened weakness. Currently, the high yield market isn't pricing in that much macroeconomic risk, but we can see that it has jumped to its highs during the great financial crisis, rising about 2,000 basis points or 20% higher than what government bonds are yielding. And more recently, during the tariffs, we saw it jump 4% higher than government bond yields. Despite the lack of urgency, we still are seeing some problems start to arise. Debt to GDP levels in most developed economies are running above 100%. Historically, they have been lowering in the post-war era, they have been lower than 60%. The Japanese market is a good example of this, and we saw some reactions the other day. The Japanese government planned tax cuts, even though their debt to GDP levels are extremely high. This caused bond vigilantes to return and shot up Japanese 10-year bond yields 20 basis points or 0.2% over 2 days. Higher debt to GDP levels mean that governments have less flexibility when it comes to downturns because their debts are already too high, so they can't borrow even more to help stimulate the economy. As a result of all this government debt, US interest costs as well as interest costs around the world are the fastest growing balance sheet item for most governments. This is reaching about $1.2 trillion per year annually, and it's the largest line item now currently for the US budget. This is larger than Medicaid, education, as well as defense spending, and it's about 3 to 4% of total GDP. This is why ballooning interest costs do matter. Taking a closer look at an example more specific to Canada and US, if we have a look at this chart here, we can see that the US has made a bit better progress in lowering their debt to GDP levels. This is mainly due to US GDP, which is the denominator, is rising faster than their debt, which is the top number. So the bottom number is rising faster than the top number. This is mainly due to the stronger economy relative to Canada. The last time we saw these levels for Canada were in the early 1990s, in which we saw nominal yields reach past 8 to 10%. Canada's not in a crisis yet, but things are looking similar to what we saw during then, with no clear paths to help lower this debt because of our weaker economy. Finally, an example of why this all matters. High levels of debt can lead to bond vigilantes returning. This chart shows you the real inflation-adjusted US 10-year bond yields and bond yields. We categorize this period into 3 different periods. The first being the old normal. This is what we saw post-Great Financial Crisis. Bond vigilantes disappeared. Central banks were buying up all the debt just due to the weaker economy, and real rates were 0%, so you weren't getting any carry for holding your bonds. The second period is the period that we're at now, around the 1.5 to 4% area. This is what we call the old normal. This is when growth is high as well as inflation is kept in check and the economy is steadily growing. The last period here is what we label the bond vigilante era, when bond investors came in and demanded higher yields for holding government debt due to their debt unsustainability as well as their budget. During this period, real rates were up above 8%, and which put nominal yields up about 10%. This led to many issues and many problems, as we saw during Canada, as well as we're seeing now in Japan. Next, I'll pass it off to Sebastian to give an update on our bond portfolios and the bond market.
Thank you, Justin. Always a pleasure to be in Vancouver, especially on a nice sunny day. A few messages I want to leave you with. So 2025 was a very volatile year also in the bond market. We did take advantage of that volatility to create some alpha. So that's the good news. The second message is I do think we've seen the end of the easing cycle in Canada. The Bank of Canada was one of the first central banks to start cutting rates aggressively in 2024. So I think we're pretty much done, assuming we could settle favorably with the U.S. on the free trade agreements. I'll get into that in a few slides. I agree with Justin that the U.S. Probably has some potential to surprise on the upside, and get into explain why we think that. And I want to leave you with one nice example of how we're advancing sustainability. So just before I get into our view of Canada and the U.S., just going over the performance we have. So we sub-advise for Genus and some of their fixed income strategies. So I've identified all the strategies. I've listed them. Actually, I put them by best performer to the worst performer. So the big difference, the winner in 2025 was the U.S. bond fund. Basically, fixed income is just pure math. In the U.S., interest rates actually went a bit lower, so that gives you a bit of a kicker. The one that had the lowest performance was the Genus government bond fund. Again, it's a Canadian fund. Rates actually went up, and it has a higher sensitivity because it's a higher duration. So when you look at the numbers, they're a bit lower than the other ones. But in the end, we were able to beat our benchmarks in most of the strategies. And we're able to do this also by having a significant reduction in carbon intensity, which is the last column on the right-hand side. So we're very happy about that. So overall, 2025 was a volatile year, but we're able to take advantage of that volatility and beat our benchmarks. So back to our economic view, where do we see the economy going, and where do we think what's going to happen in 2026? So the Canadian economy has been basically stuck with these two big headwinds for the last 2 to 3 years. The first one is the immigration policy. So after the pandemic, we opened up our borders. A lot of people came here, and then we realized we didn't have the infrastructure sufficient to be able to accommodate so many people, shut the border. So we're reducing the number of non-permanent residents in Canada, which means that the Canadian population is now no longer growing. If the Canadian population no longer grows, that means the GDP growth is going to be very difficult to grow also, unless you have productivity, which Justin explained we don't have in Canada. So we're kind of stuck in that environment where if there's no population growth, it's going to have an impact on GDP growth. So that's the first headwind we have. The second headwind we have is this chart that I'm showing here is that since the end of the pandemic, rates have been going higher. And people who have mortgages have to renew their mortgages. So I'm showing the percentage of people who have to renew their mortgages. And every time somebody renews their mortgage, unfortunately, they're renewing it into higher interest rates. So if that means less money in their pockets, again, a bit of a headwind for the economy. Now, the good news in 2026 is that if you look at, how many people are renewing their mortgages, there's about 15% of the households, which is a bit less than what we've seen in the past. So that's good news. And the second one is that rates are actually a bit lower. So overall, a bit of a headwind, not as intense as it was in the past 2 to 3 years. Now the good news, so that's kind of the headwinds we have. We have this nice little tailwind that we have, though, which is the federal fiscal deficit that the governments have proposed to deal with some of the issues on the infrastructure side. So high numbers, we're looking at about $80 billion that the federal government wants to spend on the next 5 years. So that's cumulative about 3% of GDP. So that's going to be a nice tailwind that we're going to have. And that's something new that we haven't had for a long time. And just to put it into context, $80 billion is the biggest stimulus that we've seen if we forget about the pandemic. So it's a lot of money going into the Canadian economy. Again, it's going to be over 5 years, so it's not all in 1 year. Our best estimate is that's going to be a nice tailwind of maybe anywhere between 0.7 to 1% of GDP. So when we look at what that means in terms of the market or the implications for the market is that that tailwind should be very favorable, should compensate for some of the other issues I talked about before. So what the markets are saying right now, I'm showing here the overnight, the Bank of Canada rate. So you could see during the pandemic it went up, and Bank of Canada was the most aggressive central banks cutting rates in 2024. And now what the market's saying is that the Bank of Canada is pretty much done where they are, and the dotted line is what the markets are pricing. So the markets are anticipating the Bank of Canada is going to be raising rates the next time it does something. Not sure about that. That's a bit probably optimistic, but it all depends on how successful we are in terms of renegotiating the USMCA agreement. So if we're successful, I think this is plausible. If we're not, I think we're probably going to have a different story. So overall in Canada, like I said, probably the easing cycle is behind us. I think the economy should have a little bit more momentum that we've seen in the past few years for basically the stimulus for the federal government. Now, when we look at the U.S. market, so I continue to be surprised to see the resilience of the U.S. market. And again, if you step back and you think of 2025, remember Liberation Day, Dodge, I don't know if you all remember that, an immigration policy which is basically going to result in about 1.5 million fewer workers in the U.S., and the longest shutdown in history in terms of the government also. So if I had told you that at the beginning of the year and I asked you what you think the markets are going to do, very few of you probably would have said, well, we're probably going to have a record year also in the markets. So I continue to be surprised to see how resilient the U.S. economy is. But, I mean, the facts are the facts. You can't hide behind that. The one area of weakness that we've seen, which was this justification that the central bank in the U.S. is using to cut rates, is on the employment market. So the employment market has been basically flatlining. The U.S. hasn't created many jobs in the last 6 months. And typically that coincides with the beginning of maybe a slowdown or a recession. Now, we don't believe that that's going to be the case because if you step back and you think about why aren't people hiring right now in the U.S., there's a lot of uncertainty. There's some pockets that are doing quite well. I mean, generally speaking, there's a lot of uncertainty. I think businesses are just waiting to understand what's going to happen, where the goalposts are going to be before they start rehiring. So I think the slowdown we're seeing on the job market is mostly related to the political environment that Wayne is going to give us a good idea what's going to happen going forward also. So we're not too concerned about that weakness that we're seeing. And again, we continue to be surprised by the resilience. And we know, and I'm not going to go back to the numbers because Justin's already done a good job at this, but the one beautiful big bill was basically we're going to cut taxes by about $200 billion, and we're going to raise tariffs to fund those taxes. That's what it was. And when you look at, we're going to cut taxes by $200 billion and we're going to raise tariffs by $225, so it's kind of a wash, right? So technically on the economy, that shouldn't do much. What people forgot is that the negative part of the One Beautiful Bill was all 2025, right? So the tariffs were raised in 2025. That probably cut about 1% of GDP in 2025. And the good part of the One Beautiful Bill is coming in 2026. So out of the $200 million of tax cuts, half of those are going to be in the first quarter, March or April. That's going to be a huge, huge tailwind also for the U.S. economy. So it's difficult for us to understand how the U.S. economy could go into recession, having this change. So we're going from a break of 1% to a stimulus of 1%. So when you add those two together, it's basically a tailwind of 2% of GDP that we're going to see somewhere into 2026. So it's very difficult to imagine the U.S. economy going into recession. So where we have an issue is reconciling what the markets are saying the next steps are. So this is the same chart, but for the Bank of the Federal Reserve. So again, it's the overnight rate in the U.S. So you could see, raise rates, cut rates, not as aggressively as Canada because they had a different economy in the U.S. But look at the dotted line. The dotted line, again, the markets are anticipating that the Fed's going to cut rates by 2 to 3 times in 2026. It's very difficult for us to understand that. I mean, the economy is doing well. It's been really resilient, and we're going to have this huge tailwind with the One Beautiful Bill Act that's going to happen. And maybe even more. Can I come back? I didn't talk about the gray part, right? So the gray part is if Mr. Trump wants to give more to make sure he wins his midterm elections, right? So I'm not even talking about that. But if we do get that, that's on top of. So it's very difficult for us to reconcile what the markets are pricing in versus what we think is going to be the reality. And this is the biggest risk for us in the markets in 2026 is exactly this, is that if we are right that the U.S. economy accelerates, highly unlikely that an independent Federal Reserve would be able to cut rates, and I'm glad if there are any questions on that, to entertain those at the end. So it's very unlikely that the Fed will be able to cut rates in that environment, which means that the market has to reprice that. And that's kind of a little bit what we lived in 2022, and I want to create commotion there, and not the same extent. I think the stock market continued to do well in that environment versus in 2022, but that's the biggest risk we see on the fixed income side. And if this happens in the US, it's going to have an impact in Canada also. I want to leave you with an example of a sustainable bond that we bought in the portfolio. So this is the government of Canada issued a bond, a 10-year bond in 2024, and part of the proceeds of this bond actually went to commission a new wastewater treatment in 3 northern communities in Alberta. So obviously very good for the environment. We're retreating water, but more importantly, what this investment did is that it created skills, created jobs on some Indigenous communities. So that's something that we really wanted to highlight, because I do think that we're seeing more and more of these opportunities, and that's something that we as a firm, and I think collectively as a society, we want to do. We want to promote activity on some communities, and we could do this through these kinds of investments. I'm going to stop there because I want to hear what Wayne has to say about what the world is going to look like in the next year. Thank you.
Good morning, everybody. And I agree with Sebastian, basically. It's going to be a good year next year, economy-wise. And, he sees stronger growth as a concern for the bond market. We see as opportunity for the equity side. So we love that. Thanks. As Justin and Sebastian explained, lower interest rates and government spending is going to help the economy next year and help produce a cyclical recovery. And our view is that where the markets are going is aligned with this perspective. We see the market broadening out next year. It's going to go beyond just AI, and we think the average stock is better value, and the stronger economy will be a catalyst as well. So in that kind of environment, in a stronger economy, you tend to see cyclical stocks outperform, value stocks outperform, and small caps start performing. And all our forecasting models are forecasting these 3 things to happen next year. And Justin will show you more of that from our dynamics strategies. And we anticipate U.S. and Canada still outperform the rest of the world next year. U.S. is going to be the strongest economy, we think, in the developed world. And Canada, being next door, will help, will be a beneficiary, and also from commodities going forward. Now, looking at the average stock, we have 2 charts here, 2 lines here. The blue line is a Standard & Poor 500. And the orange line is the equal weighted S&P 500. So it's the average stock price earnings ratio. You can see for the blue line, the S&P 500, the current price to earnings ratio is 22. The orange line, the average stock, if you will, is 17, big spread, wider than normal, as well as the orange line is closer to its long-term median. So, if you look at the mega caps, the Mag 7, for example, they're 1/3 of the S&P 500. That's how big they are. That's that kind of a weight they have in the index. So it's very important to understand that. And we think they've done very well. They're still going to perform fine, but the market will broaden out into the average stock. And we think that the stronger economy will be a catalyst for that. As I mentioned, cyclical sectors with our models are turning around. They started to outperform in Q4. We think that's going to continue into 2026. Same thing with value. Value always does better when the economy turns around. Why? Because people can trust the earnings and the price earnings ratio. They also anticipate higher earnings, and there's just more risk-on type environment. So we think value will continue to do well. And we started restructuring our portfolios, pushing more value in the last quarter. And we're seeing a bottom forming in the small capitalization stocks, which always do better in a stronger economy. Our models went positive in those mid-year, and so we think it's going to continue into the coming year. And as I mentioned, Canada and U.S., we anticipate will outperform. Stronger economy from the U.S. And if you look at over the past 20 years, the U.S. is just a machine. Its earnings have gone up 200%. Canada's have gone up 100%. And the rest of the world 25%. And I saw Chancellor Merch give his Davos speech, and what was he talking about? He was talking about deregulation, having to be able to compete globally. So I think the world is figuring out, U.S. has a formula, we better get on that train. So we still anticipate more wealth creation in the U.S., and Canada will be a beneficiary of a stronger economy there, as well as better, good commodity performance. Now, AI leaders, we think they are expensive. It's not 2001, folks. We don't believe in that at all. It's not a bubble. We think they'll continue to perform, but not at the same rate they have in 2025 or 2024. AI performance has been driven by earnings growth mainly. And leaders like NVIDIA, they're selling below their historical valuations. The Mag 6 is near its historical averages. And analysts have actually downgraded their growth estimates, their forward growth estimates, their 5-year forecast for the Mag 6. So they've already downgraded some expectations. So we're not in bubble-licious territory, we believe. If you look at NVIDIA's earnings, the orange line, versus the blue line, their price, you can see in January 2024, earnings have gone up faster than share price. And since then, back in 2024, the multiple, or price earnings multiple for NVIDIA was about 30, 31. Today it's 24. So it's selling cheaper than it is, and typically earnings drive share prices. Over the long haul, earnings drive share prices. We've seen it here with NVIDIA. It's been driven by earnings, and valuations have actually improved somewhat. Here's the average price earnings ratio, or price earnings ratio over the past 10 years for NVIDIA. It's gone from a high of 60 in 2022 down to 20 just during the Liberation Day in April. Right now it's around 24. The median's around 31. So the market is rational. It's dropped the multiple on this high-performing stock. Now, if you look at the Mag 6 price to forward earnings ratio, the Mag 6 is Apple, Amazon, Google, Meta, Microsoft, and NVIDIA. We've excluded Tesla because its valuation is extreme, folks. And a lot of its investors are anticipating autonomous driving being a big contributor going forward, as well as the robot business, and also just Elon Musk's brilliance in terms of creating new ideas. And he's a great salesman. Let me put it that way too. He's a great salesman. So it's got a really hefty valuation. But overall, the past 6 years, we're at the median of the remaining Mag 7, the Mag 6. And if you look at growth rates were up around, say, 18 up until 2024. They're now they've been down to about 11%. So even if valuations stay where they are, the earnings growth rate is going to give you, say, 10, 11% in this group over the next 5 years. And I think we'll take that after all the excitement we've seen over the past couple of years. Now, one of the hot topics from our clients, as Shannon mentioned, clients are really, there's what the heck's going on? There's so much going on out there. We believe we're in a transition to a new world order. And I just want to make the point that this has become a really hot topic at Davos. And this presentation, I will say, we created this presentation prior to Mark Carney's rant at Davos, and so I think he stole our presentation, not vice versa. No, we were on this, and we don't have any crystal ball. We're just trying to create a hypothesis about what's driving this crazy world, what can explain it, and so that's what we tried to do here, and then try and verify that by looking at what the U.S. is actually doing out there. So we want to address why the system is changing, what this new world is. We're moving from a unipolar world to a multipolar world. And does the U.S. strategy and behavior correlate with this multipolar model? And we think it does. Okay, so before we go forward, we have to go back and see where we came from to try and figure out where we're going. So first off, in 1944, it was the end of the World War II. Europe and Japan were flat on their backs, and England was broke. And so in 1944, the U.S. came up with this new deal that would be the new international monetary system. It was the Bretton Accord. Number one, they pegged the dollar to gold and offered it as a reserve currency. They created global institutions like the International Monetary Fund, the World Bank, and the World Trade Organization. And they offered free trade in order to counter the rise of communism. That was a big threat back in the days that people have forgotten about. So, that ain't the world today, folks. So the U.S. monetary discipline was maintained due to the peg of the U.S. dollar to gold. Now, that all changed in 1972. The U.S. government had built up a lot of debt because of the Vietnam War, and their trading partner said, hey, we don't want your paper currency, just give us the gold. And Nixon said, no, I think we can't do that, it's too much gold. So they broke the dollar peg to gold, and they backed the US dollar with effectively their bonds. And so when Japan sold cars to US, they effectively got bonds in return. And as long as the US was solvent and strong and a superpower, that was a good deal. And in 1992, after the fall of the Berlin Wall, the US was the unipolar power. They were untouchable. And as John McCain would say back then, Russia is a gas station with nukes. We don't care what to worry about them, blah, blah, blah. And Fukuyama wrote The End of History, where we were moving into liberal democracies and capitalism, the end of the forever. Well, he got that wrong, very, very wrong. We don't have that today, unfortunately. We have some of that, but it's not, everybody doesn't have that. So there was a bit of a victory lap. And so what's changed, and why are we moving to this multipolar world? Number one, China and Russia have really emerged as superpowers. China is a manufacturing superpower. I would say Russia is more of a regional military power. And another important issue here, obviously, is the rise of U.S. debt and the fiscal strain, the solvency of the U.S. It's constraining their ability to act like a superpower. There's an overuse of the U.S. dollar. It's been weaponized, and that's impacting. I'd say the seizure of Russian reserves undermines the trust in Western currency. You can say whatever you want, you can moralize all you want about the seizing those reserves, but other central banks, other investors say, hey, if the U.S. or the West doesn't like my behavior, they can come and grab my assets. Why would I want to hold U.S. dollars? It's that simple. They did, in fact, during the World War II, they never confiscated the Germans' central bank assets, and so you're hurting your own currency when you do that. We're also seeing commodity producers, countries that produce commodities, prefer real assets over treasuries. So the whole idea is, do I want to give my commodities up, which are going up in price, versus those treasuries, which may not be solvent? So that kind of behavior is taking place right now. And then you're seeing a global competition for energy, minerals, food, and trade routes. So what is this new world going to look like, or looking like? So number one, power becomes important, not just rules. And Carney kind of dumped all over the rules-based world in the first place. He said it was a facade. And I think he was, the point is, the superpowers use the rules when it serves their purpose, and don't use them when it serves their purpose. So number one, there's a security competition taking place between these multipolars, U.S., China, and Russia. And they become less constrained because they're in a hurry. They want to, especially the U.S., it has to protect its dominance. And in terms of reserve, we're moving to a hybrid reserves, central bank reserves. They're using treasuries and gold and commodities. And in fact, we're seeing alternative institutions that will bypass Western institutions like SWIFT. And some of the BRIC nations are trading in their own currencies head to head, and they balance their trade accounts at the end of the year, say, with gold. So they'll trade with their own local currencies and balance up in gold later on. So they're moving away from the US dollars because of the solvency issues and the weaponization. We're seeing regional blocks form, fragmentation of trade and technology. You're seeing the US put trade embargoes on the high-end NVIDIA chips, for example. And international laws being applied selectively. We've seen that with Greenland. Professor Mearshammer from the University of Chicago, who's into real politics in reality versus what we hope it is. And then Ray Dalio, the head of Bridgewater, they said that they've studied history. Their view is that the powerful obey the laws when it serves their interest and don't when it doesn't serve them their interests. So does this help explain some of the behavior of the U.S.? Well, the U.S. is now, I think their behavior is, the delivery is crazy, okay? It's ham-fisted. But behind that, it's rather pragmatic. Let me put it that way. And it reflects the reality of the multipolar reality. Number one, to protect their interest and to get their way, they weaponize tariffs, sanctions, and they're using trade as a strategic tool. They don't have the money anymore, and to cover all the costs for NATO, so they're saying to their allies, we have to share the burden, guys. You got to come across, and Trump's been doing that. They started reshoring all the strategic industries, energy, minerals, semiconductors, and defense supply chains, and they're reducing reliance on China for manufacturing and technology. And they've reinserted their influence in the U.S. We saw that from the get-go. They wanted to take Canada. They wanted Greenland. They're in Venezuela. They're probably going to go after Cuba next. And some people are saying, well, they just want to, they recognize the challenge from China, and they want to just have their piece of the world and take care of that. I think it's bigger than that. I think they want to make the Western Hemisphere as their home base, and then move out there and limit China and Russia. So it's just, let's take care of our own backyard, make sure it's secure. I'm getting the high five here. So I've got to move on. And so they're very pragmatic, I believe, and it's because they're being challenged. They're still a dominant power, but they don't have a monopoly anymore, and they have to be, I think they have to be nicer longer term. I think Carney made that point. But I'll talk more during question period because I'm getting the hook here. But so up next is Steph, and she's going to talk about the State of the Union for ESG. Thank you.
Thank you, Wayne. Your storytelling is always captivating, every day in the morning. Very good to see everyone today. So for ESG, we have seen a lot has happened in the world. And these developments, they all have very immense implications for sustainability. Starting with the changing political landscape in the US, and also the development of anti-ESG sentiment, and also changes in related policies and also regulations. In response, we have seen the sector and also investors, they have recalibrated. And the rise of AI, and coupled with shifting national priorities towards energy independence. And we see them presenting both risks and opportunities for not only the renewable energy, clean energy transition, but also the whole energy landscape. And then seeing these changes and also the mega trends that are emerging, so investors have also shifted the sustainable investment priorities. So with the political landscape shift in the US and rising of anti-ESG sentiment, we have seen quite a few changes, or quite a few ESG policies, incentives, and regulations rollbacks. These are not only seen in the US, but we are seeing changes in Canada and also Europe. Just talking about US and most notably, on the very first day of Trump administration, it has already initiated a withdrawal from Paris Agreement. And so far, they have exited and is planning, still continue to plan and to exit from a total of 66 different global climate organizations. And traditionally, US has been backing these organizations, and many of them are UN organizations. And now back home in Canada, and we are seeing a bit of mixed strategies towards sustainability. With the latest budget, we have seen it has reiterated stronger methane regulations, extending tax breaks for carbon capture and storage technology, and also tax incentives for clean electricity investments for Crown Corps, for provinces to expand their renewable energy infrastructure. And also they have committed to put in place a Made in Canada Sustainable Investment Guidelines, the so-called Canadian taxonomy. And but at the same time, we are also seeing some ESG policy rollback. For example, the Bill C-59 essentially rules to fight against greenwashing, and also quite a few funding cuts to a number of different climate organizations and environmental agencies in Canada. So now in Europe, so what we have seen is it is also loosening a lot of its sustainability requirements for corporates, and also simplifying its EU taxonomy, and also putting in more simplified language within its sustainable finance disclosure regulations. And this has a lot of implications because EU taxonomy and its disclosure standards have often been regarded as the standard or benchmark for other jurisdictions to follow. So all these reforms, what we have seen is it reflects a common theme, which is nations and countries, they are shifting towards regulatory burden reduction and also ultimately to boost national competitiveness, economic growth, and also to preserve sovereignty. Another phenomenon that we have seen is green hushing. So with all the anti-ESG sentiment and also very negative media coverage, changing political landscape, so a lot of investors and companies, they have become hush-hush. And so they are not reporting as much or basically cease to report on the sustainability efforts or targets that they have set or achievements that they have made to avoid any legal or reputational risks. However, if we look at how capital actually flows, it actually paints a more positive picture. We have looked at a global sustainable fund flows data, which covers the first 3 quarters of 2025. And globally, the net outflows is far from a dramatic retreat. It is actually more resembling of a sidelining type of sentiment. Despite outflows we have seen in the US, commitments in Europe, Asia, and also Canada have remained quite intact. To give you some data points, in Q3, the net outflows globally was $7 billion. In Q2, it was actually an inflow of $6 billion. In Canada, we are doing great. We actually recorded a $700 million inflows in Q3. Asia attracted a net inflow of $1 billion. And and for Europe, what we have seen is a shift from generic sustainable funds or ETFs towards more custom ESG mandates. So in the short term, it seems that like sustainability, it has faded to the back seat, especially for those that are on the fence to start with. But with the imminent need to decarbonize, the very need to find more reliable energy, clean energy sources to power AI, and also changing or shifting national priorities and changing demographics, these are not going away. Authentic investors and also market participants and players, they are staying the course, they are staying committed. And this is quite consistent with what we have seen from our own clients and also some of those that are not our clients and other institutions. So the approach that they have taken is some of them, they are taking a more measured approach when it comes to putting in net new capital into the space. Others have doubled down. And from our conversations when we were in the US at SOCAP, capitals are still very much flowing. They are just a little bit hush-hush under the hood. The rise of AI is both a risk and an opportunity from a sustainability point of view, with massive developments in AI. Energy demand to power AI data centers, they have also skyrocketed. And IEA, for example, it has projected data energy consumption will be doubled by merely the end of 2026. And with all these increased massive energy demand, it requires all forms of energy that is available. The good news and the opportunity is renewable energy will be a key part of the solution. The risk is to fill all these immediate energy demand. We have seen more conventional carbon-intensive forms of energy from fossil fuels. They have also they have also seen much increased demand as well. Major technology firms, and they are also making massive investments in energy infrastructure to power the data centers. And clean energy has been identified as the solution, or at least a very, very good part of it. Just to give you some example, Microsoft, Meta, Google, they are spending billions of dollars and also enter into long-term power purchase agreement, PPA, just to restart a lot of nuclear power plants, backing geothermal projects, or securing other renewable energy sources to power the data center. And so with that, we see that energy storage, wind, solar, they are the key areas for opportunities. And for wind and solar in particular, they now represent the fastest and cheapest way to get energy online. Next-gen solutions such as nuclear and geothermal, they are also getting a lot of traction because they do provide very consistent and stable baseload power source, which can be a great complement to renewable energy like wind and solar, which tends to be a bit more intermittent. And also, in other ways, AI also improves or encourages a lot more adoption of renewable energy by improving renewable energy system. This could be done through grid optimization, energy forecasting, predictive maintenance, real-time monitoring, All these will enable more efficient integration of decentralized renewable energy sources onto the grid. And ultimately, what will happen, it will increase efficiency, reliability, and also lowers the operational cost of renewable energy, and ultimately increasing the adoption. However, we are still in transition to a green energy future. So to fill all these enormous energy demands, we have seen fossil fuels, especially natural gas, have been tapped to fill these needs. Another key consideration is with current pace of development, renewable energy generation should be able to keep pace. However, with underinvestment in the utility sector in the last 1 to 2 decades, energy infrastructure has not kept pace. And we have seen a lot of renewable energy projects, they fail to secure grid connections. So much more investments are urgently needed to modernize grids, to build up energy infrastructure, because we are already seeing strains and congestion problems, or even blackout events that are happening on the grid. And the more occurrence of severe weather events are not helping as well. So with all the political, geopolitical, macroeconomic backdrop, we are still seeing a lot of real-world threats and also reported huge losses in our everyday headlines from severe weather events. So we are seeing sustainability-focused investors, they are now shifting to emphasize a more pragmatic approach with increasing focus on value creation investments through emphasizing risk management and also financial materiality, such as climate adaptation, climate resilience, and transition readiness. And also, we looked at a Responsible Investment Association report, which basically looks at the ESG landscape for Canada in 2025. The top driver for sustainable investment is the risk of climate change, the risk of changing climates, and the impact. So we can see that investors are still seeking to create value through managing tangible and imminent risks. And then so therefore, so climate resilience, climate adaptation, these areas are those that help systems, companies, people, communities to cope with the real-world impact of climate change. And these have progressively climbed higher on investors' sustainable investment priorities, coupled with enormous energy demand surge from AI and also the race to energy independence and renewable energy infrastructure, they are in dire need for investment. So looking ahead to 2026, and so overall we have seen renewable energy, energy infrastructure, water solutions, water management, healthcare. These are the areas that have done quite well in the current environment, which can be basically characterized by AI race, climate realities, changing demographics, and shifting national priorities. So we do expect these key sectors will continue to flourish in the near future. And food sovereignty and also companies that invest and have done well in transition readiness, they should also deserve some attention. And so what it means for Genus and for our clients is that we will, for our fossil-free and impact strategies, we will engage more resources and continue to focus on companies that are well-positioned in these areas that create value for a smooth transition through either a risk management lens or through investing in these growth opportunities to drive towards a sustainable future and faster. So with that, I will pass on back to my colleagues to talk about the commodity and dividend fund.
Thanks, Stephanie, for the update on the ESG side. So looking at the presentation that we heard today, it was a lot about 2025 and 2026, which does look pretty good. But there will be a bear market one day, and we're banking on our active asset mix process to help protect clients' wealth. We've done a few things in order to improve our active asset mix process, which we call the Genus Dynamics. We've added a new product that recently launched last year, our commodity fund, which I will discuss a bit later. And in addition, Lisa will discuss our dividend strategy, a fund that we think is core to helping protect clients' values. At Genus, on top of building stock models, we also build macroeconomic models to help make sense of the world. This is what we call our proprietary software, Genus Dynamics. These can range from different equity markets, bond markets, as well as cash, currencies, and commodities. We do this by categorizing factors into 6 different buckets: the economy, inflation, monetary policy, valuation, risk, and technical. Some examples of this are the PE ratio that you saw from Wayne, as well as the inflation numbers, CPI. We tend to have about 10 to 15 different factors in each model. and then we have a process of picking factors that do have predictive value. For example, for the stock versus cash model, every month, every factor gets a signal, whether that's positive, neutral, or negative, and then we sum it up together to get a final vote. In the end, if the combined vote for, let's say, the stock versus cash model is positive, then we're favoring stocks over cash. The next slide also illustrates some of our signals. We have over 40 different macroeconomic models, but these just highlight some of the more important ones. So we are positive on equities right now relative to bonds and cash. Within equities, we have a slight favoring towards the TSX and S&P that Wayne mentioned, as well as we're favoring the cyclical, which we saw in Wayne's slide, where we saw the rebound in those cyclical stocks. On the bond side, our models are favoring more of the spread products, especially in the US, with the corporate bonds, as well as high yield, as we're seeing not much risk priced in currently. On the currency side, we are favoring the US dollar, as it's been trading at its bottom for the last year, but that's due to some of the uncertainty that we've seen. Moving on to why we launched the Genus Commodity Fund, this is what we call the bull and bear chart. This chart takes a look at the big picture, looking back at S&P 500 returns all the way back to 1870. We look back at the regimes and classify them as bull and bear regimes. So bear markets are the ones shaded in blue. We then take those periods and then look at the returns of different asset classes during those periods. From the chart on the left, you can see that during bull market periods, equities outperform significantly, with the S&P 500 outperforming significantly compared to even the TSX and the rest of the commodities. On the chart on the right, you can see that during bear markets, though, it's a completely different story. We see commodities tend to outperform, with oil, gold, copper, and silver all in the positives, while equity markets lagged. Commodities essentially act as a hedge against the equities, and the takeaway here is that we expect commodities to help protect client portfolio values. This chart also highlights those correlation differences. From this chart, we can see that the Auspice Diversified Fund, which has a track record of over 15 years, is negatively correlated with most of the other asset classes. Auspice is our sub-advisors for our fund, and this strategy is very similar to the one Genus is employing. What this means essentially is that when stocks and bonds go down, commodities will either stay flat or actually add value during those times. This final chart here is a classic investment chart showing the relationship between risk and return. So the further up and right you go, the more risk, but also the more returns they're getting. In the bottom left, you see the typical bond. You typically see bonds as they're usually very low returns, but they're also very low risks. And on the top right, you usually see equities because they're very high risk, but also provide that extra return. From this chart, we can see from the red dot, the commodity fund lies somewhere in the sweet spot in the middle. Its returns are more equity-like, but its risks are still more bond-like. So we think that this will help diversification heading into the future, as well as heading into bear markets. Next, I'll pass it off to Lisa to discuss our dividend fund.
Hello, everyone. My name is Lisa Zhang. I have been working at Genus for 18 years. I'm overseeing the portfolio construction process, managing the investment strategies, as well as conducting the equity research. As our top priority is always to align clients' values, we conducted research and implemented the low volatility, high yield strategy back in 2009, right after the financial crisis, aiming for protecting our clients' values in market downturns. So this is a global managed strategy. We built the best qualifying stocks over Genus Research Universe, which has over 2,000 world's largest companies. To ensure clients with stable income at the current target yield of 3.5%, we pick the stocks that can pay higher yields and reliable dividend growth. More importantly, we have to make sure the strategy is lower volatility. In terms of our investment approach, we use a best of best approach, which means we select the best companies within each sector and the best appropriate sector by region. For example, in Canada, we have more candidates from financials, natural resources, such as gold. And in the US, we have more candidates from technology, consumer brands, and healthcare, while internationally, we can pick more from industrials and financials. To make sure it has better risk protection, especially with the rising volatility of the market, we set layers of protection. First, it has to be a stricter risk control, which means we pick companies with lower residual volatility. Second, we want to make sure the companies can pay consistent yield. Third, we want to avoid the value trap, which means in the down market, investors may flee to safe haven by only one or two factors, such as high dividend yield. Based on our study, we demonstrated that companies that can pay consistent, sufficient cash flow yield and positive dividend growth can help reduce this risk. Lastly, our strategy is further secured by our internal grades, which are supported by strong model results. As a quantitative asset manager, we have a disciplined investment process, and our proprietary research platform stores over 30 years of research results. In particular, we have over 40 stock selection models that cover Canada, US, and international. Within each model, we combine the best performing factors from various styles, such as the street analyst estimates, price momentum, and value factors. The final model structure is supported by our extensive long-term backtest results. So at the very beginning of each month, we'll get the full list of the latest stock grades, from high to low, A to F. The investment rule is straightforward. We always buy high-grade names and then sell low-grade names. This chart shows our point-in-time dividend fund statistics as of December 2025. So we can see for this fund, it has a more defensive and value tilt versus others. For instance, beta, our dividend equity, has 0.84 versus a benchmark of 1. Well, on the other hand, for the dividend yield, we can offer our clients with 3.5%, almost double than the benchmark. Another factor, PE ratio, the lower the better. So our dividend equity is 16 versus a benchmark of 24. For comparison purpose, there's another in-house equity fund, CanGlobe, being provided here as well. It is a more growth-driven strategy. This is why, if you look at the beta, it is closer to the benchmark, which is 1.01, while it still has better value exposure, 20.5, below than the benchmark. More importantly, since it's more growth-driven, the 5-year forward earnings growth is 10.4, the highest. And we change our strategy dynamically, so for this portfolio statistics will change from time to time. Our dividend equity has proven a long-term robust performance with sustainable income. So let's focus on the 3 factors in orange at bottom. First of all, over long term since inception, for our equity fund, it provides lower volatility. The beta is 0.73 over 16 years. Well, in the meantime, it can provide consistent, strong excess return of 2.5% per annum. More importantly, as a key downside protection product, we want to make sure the effectiveness in the protection. Over the past 16 years, if we look at the down market capture ratio, the lower the better. So it shows our dividend fund has 35% less loss than the market. In addition, we also compare against our peers. This is based on the investment global dividend equity universe, and our fund is plotted in blue. We put all the fund performance into quartiles. As what we can see here, dividend equity always beats the peers, and most of the time in the top quartile or even 98 to 99 percentile. Again, for the comparison purpose, we also provided the CanGlobe equity, which is the growth-driven. It also shows a consistent, robust long-term performance. Year 2025 was another great year for Genus equity funds. In particular, our dividend fund equity has beat the benchmark by 10% with a net return of almost 30%. We want to figure out why, because for this strategy, we cannot buy in the Magnificent 7 names due to their nearly zero yield, such as NVIDIA and Apple. However, we have other good IT names we can buy, such as Seagate and IBM. Differently from other dividend equity funds in the industry that mainly pursuing for defensive sectors or high yield, we have a more dynamic strategy that we can rotate our sectors, country exposures, and risk parameters quickly based on the market movements. And for the fossil-free clients, we also have a lower beta strategy that we can invest in, which is the impact fund. Thank you, everyone.
Thank you so much, all of you. Thanks, Lisa. So we've hit you with a lot of information, as I warned you we might. But we also have, so we've sort of let you know what our next steps are, what our plans are, and we wanted to give you something to walk away with, something to do with all of this information. So our focus is on discipline rather than reaction and long-term outlook, and that's what we're encouraging you to do as well. So there are a couple of questions here that you can ask yourself about your portfolio and what you want to do with it. But what I'd recommend more than anything is if you have any other questions, if you're feeling concerned, this is what your portfolio managers are here for. So please connect with them, have a meeting. For those of you online, you can do that via the website. And for those of you in the room, you have access to all of them here today. And for those of you who are not Genus clients, because not everyone in the room, particularly on the live stream, is a Genus client, our portfolio managers are willing to have a chat. Education is really important to us at Genus, and so if you'd like to have a conversation with them, you can also find their contact information on our website. So with that, we will open it up to the question period. I'm going to start in the room. So do I have a mic that I can run? I can't see anything. Oh, you're going to run for me. Thank you, Graham. That's fantastic. Are there any questions in the room? Just raise your hand if you have a question in the room. Thanks.
Thank you very much for the presentation. The question I had, we talked a lot about this volatility that's caused by the United States and how they're approaching tariffs and all of this kind of stuff. And I keep watching the news every week because I keep hearing about the Supreme Court of the United States going to come with their ruling eventually as to whether or not these tariffs are legal or not. And if they're ruled illegal and the tariffs have to be returned, what does that do to the investments?
Wayne, I think that's for you.
Hi. Yeah, no, that is a risk out there, and I guess the announcement is imminent. My understanding is that they have alternative routes to reinforce some of the tariffs, not all the tariffs. I don't think all the tariffs will be knocked down, certain ones, and it's going to be a battle. I presume that the Supreme Court will give the administration a heads up, given the severity of the situation. So it is a risk out there, but my understanding is they have alternative mechanisms to get the job done.
Thank
But
you.
there could be some beneficiaries in the retail land in the U.S., and it could shift things around to some degree, but my understanding is there are other mechanisms to deal with that issue.
Thank you. So I'll go online now because we have quite a few questions online. So one of the questions coming from the live stream audience is, given ongoing concerns, this one's for you again, Wayne, sorry. Given ongoing concerns about inflation and the strong run that gold and silver have had in recent years, what is our view on precious metals and how are we currently positioned?
We have exposure to gold in the client portfolios and in our commodity fund. They are long gold there, and that's been the fund's been a beneficiary of the gold run here. In terms of our view on gold, our models they're marginally positive right now on gold still. That was last month. They've had a heck of a run this month here already. I think gold right now is probably a bit overbought on the near term. And looking at the gold-silver ratio, it's probably, well, actually gold is cheap versus silver. Silver is crazy town. But it just is what's going on here, obviously, is central banks have been buying gold the past 2 years, and that's helped driving it up. And you're probably getting retail involved in it right now and taking it to new levels. And, it's the whole issue with Greenland, for example, pushed it. So the issue with gold, folks, is that it's really the anti-play on the U.S. solvency. If the U.S. can come back, this year, next coming year, have good growth. They're going for a growth strategy to grow the economy and bring down that debt to GDP level that Justin showed you. It's the most important chart out there. In fact, Secretary Bessent, he talks about that all the time. They want to bring debt down versus the overall economy. And how do they get that going? They get that going by getting strong growth with relatively low inflation and work on the deficit. So they made a big payment, the big beautiful bill, as Sebastian and Justin have talked about this year, because it's an election year, surprise, surprise. And in an election year, we tend to get more growth because there's an election coming, and equities tend to do pretty well because they want to keep everybody happy. So the issue with gold here is it's had a great run with all central bank buying and the inflation hangover we had from COVID. Can the U.S. turn things around? If they can turn their things around and provide more solvency with their debt situation, it could be a top for gold. I'm not forecasting that. I'm saying that's what we have to see a top in gold. Is the Bessent plan really work, where you get the GDP growing in nominal terms with low inflation and growing faster than debt. And Canada has to get on the bandwagon too. You know, if you go back to 1992, the Chrétien government did a great job, and it was hard work, but we have to get on that. Now, what some people are saying is, with what's going on now, gold is actually saying that everybody's giving up on government ability to get a grip on debt. That's yet to be determined. I'm still hopeful that this year we'll find out the evidence to that. So a big question mark in that regard. But right on a short-term basis, it's ahead of its skis, I'd say.
Okay, thank you. Any other questions in the room? Okay, we can go. Oh, there we go. Thanks.
Given the tensions between China and Taiwan, what's your outlook? And if something were to happen, its impact on the semiconductor industry in particular and the markets in general?
I'd say, number one, it would be probably quite severe in terms of, I guess you could write a scenario where maybe China went in and took over Taiwan Semiconductors and said, everything's cool, guys, we have control, but we're going to keep producing chips. That would be okay. My sense is that the two global superpowers, China and the U.S., are casing each other out. They're just like shadow boxing right now. And they understand, well, Trump, number one, understands he's got to get elected. And the Chinese understand that they have a lot of people to feed, and they're preparing. Usually these things break out into kinetic war when you get an escalation to the point where the other party has to react. For example, in World War II, it wasn't until the Americans embargoed oil into Japan that they attacked Pearl Harbor. They had no recourse. They were out of energy. That's why energy is so important. In fact, the Chinese are stockpiling piles and piles of coal, which they can make synthetic energy out of. So everybody's kind of preparing. It's like a Cold War, but they want to keep things going to keep their populations happy. And so far, it's a competition, but not a war yet, a kinetic war. But it would be severe, I think, if Taiwan was taken out. It's one of the big risks out there as well.
Okay, we'll go back online because we have a few online. This one's interesting. How damaging could a non-independent Fed be for 2026 and beyond?
Me?
Sure.
Okay.
I think it's you again.
My view is this is overdone. Okay. I think guys like Hassert are great, really great. He's a great economic mind. I've seen him follow him for years. He's a good guy. And at the end of the day, the Federal Reserve has to get unless it's over and we're just going to monetize everything. The Federal Reserve has to get a grip on inflation. The Federal Reserve can control the short rates, the T-bills. They can't control the long end. And Just was talking about the bond vigilantes. And so they can't control the bond vigilantes. Well, the only way the government can do that is where the central bank comes in and buys all the bonds. Then it's a pure monetization, and gold will go through the roof. So at the end of the day, the head of the Federal Reserve doesn't have full control. He's just one vote. He tries to whip everybody into a direction. But at the end of the day, they have to get the long end of the 30-year bond in the U.S. has to be maintained controlled. It has to come down or stay stable. Why? Because that's where everybody gets their mortgages from. And there's a lot of mortgages rolling over in the next few years in the U.S. So, say what you will, talk about it. They're going to have to dance to the tune of the bond market at the end of the day, and their performance is going to matter, and they're not going to have full control in the first place.
Anything else in the room? Just raise your hand. Okay, we'll go back to online. We have quite a few there. So this is just coming in the last few seconds. Tailwinds from tax breaks surely offset by tariff impact, i.e. tax on consumers. This person is curious as to the bull case on U.S. equities in the presentation, given that, and would love to hear more insights.
Well, I don't think it's dollar for dollar.
Okay.
I think the cut in taxes is going to be a positive in the economy. And when it comes to the tariffs, it's not the U.S. consumer doesn't pay the fare. It's probably shared by the producers. What happens is typically the producers will cover a third of it. Maybe a third will go to them buying other products or substitutes, and then the third will go to the consumers. So it's not, and that has been the evidence. It hasn't been inflationary so far. So I think that statement there doesn't add up. In terms, it's not one for one. It's maybe one for a quarter or a third or maybe a half, but it's not one for one.
Okay, thank you. This one's for Stephanie. Will nuclear be included in the Genus fossil-free portfolios?
Thank you. That's definitely a possibility. We actually recently took a pretty deep dive into the issue. So just a little bit of background, and recently we have seen nuclear talks have really surged, thanks to geopolitical tensions, and also the war between Ukraine and Russia have really put the issue of energy independence into the spotlight, and also AI energy demand. So a lot more kind of attention has been given to nuclear. Nuclear itself is an emission-free form of energy. And so its merit also comes from it provides a very stable and consistent baseload power, and very complementary to renewable energy, as I talked about earlier. And so it is also considered as a very good bridge solution as we are still transitioning to a full green energy future. So that's why it's getting kind of more and more traction. And it is not without its consideration, because especially given the radioactive waste, and it does take thousands of years to decay. So right now, the management is really to bury those in very deep geological disposal facilities. And so there is like some externalities that we don't know right now. But for Canada and U.S., and especially for Canada, we do have a very good regulatory and also legislative structure to guard against nuclear. And also we have very high safety standards. So kind of that counterbalance that. And we have looked at in our equity strategy. So how can we potentially accommodate that? Like most of the companies that have substantial exposures in nuclear utilities, nuclear energy, they are also having quite significant exposure to oil and gas generation and even thermal coal. And so, and also actually quite a few of them, they have quite substantial exposures to military contracting and defense. So that's why, as of current, they are out of our scope for fossil-free and impact strategies. But we do have some exposure through our Global Impact Bond Fund, which is through some of the Government of Canada green bonds holdings, and they have some investments that are earmarked for some of the renewable energy projects. Right now, the exposure is still pretty low, about 0.2% of the whole fund. But we are continuously kind of monitoring the universe that we could consider.
Great, thank you. Anything else in person? It's hard for me to see all of you, but I don't see any hands. This is another one from online. The U.S. has, this will be for Justin. The U.S. has a K-shaped economy, but the consumer basically drives the economy. Taking into account, I just lost it. Taking into account flat job numbers and increasing energy costs, can the economy still be redolent?
Yeah, so the consumers are a big part of the U.S. economy, along with now net exports. But we have been seeing from the chart I showed you, and Sebastian also mentioned it, about $200 billion worth of tax cuts coming in just for individuals. This doesn't include any corporation. So given that number, and again, it's an election year, we do think that they'll still be strong, especially heading into the second half of this year. We'll probably see a lot more spending on the consumer side.
Great, thank you. Okay, great. And another one, this one will be for Wayne. What are you expecting in this midterm election year? And are you expecting a recession in Canada or the US? Let's just hit it all in one.
Yeah. No recession. Typically in the midterm, the opposition always wins. If you look at the betting odds, they're betting on that right now. The polls are definitely leaning. Trump's got a lot of ammunition coming, though. They've set it up, of course. All the tax gifts are coming, right? And the economy should be moving stronger by then. So that's going to be their counter, I would say. But it's very difficult for the incumbent to win the midterms. Right now, I'd say the Democrats, if I had to make a call, I'd call Democrats win the House, Republicans keep the Senate.
Thank you. This one, let's go with Justin for this one. How will you protect growth for clients who are invested in Canadian resources or manufacturing?
Yeah, for clients that are invested in Canadian resources and manufacturing, we actually saw Canada do quite well last year, driven by the commodity side and gold side. So just by investing in those kind of stocks, the metals, silver, copper, gold, we do think that we can still add value, again, through our top-down process, where we're looking at more of the overall economy and deciding whether we want to buy more commodities or not, as well as through the dividend fund, we can also buy those commodity stocks. So we are getting a lot of diversification there.
Yeah, and to add to that, in this new multipolar world, commodities matter strategically, obviously. And Canada is a commodity superpower, which gives them more leverage, being a middle power, and it's going to drive us forward. It's our ace in the hole, I think, going forward in terms of this country, where it's going in this new environment.
Thank you. This one's for Stephanie. Sorry, my list keeps moving. Can you further explain how the commodity fund fits into the ESG mandates for fossil-free and impact clients, please?
Thank you. This one's going to be a long answer, if you can bear with me. So actually, maybe our clients don't know, we actually put in a lot of sustainability and impact considerations when we designed the commodity fund. And so basically, in short, in the design or selection of the commodity investment universe, we actually look at, so basically the principle is we will only include those commodities that have a net positive impact. So how do we look at this impact? We look at the impact throughout the entire life cycle of a commodity, from production, extraction, utilization, for some commodities, even the end of life cycle management. And we look at environmental, social economic impact. And also one aspect which is quite key to our framework is we also look at the structural versus non-structural impact. So structural impact are those that are very core to the commodity, something that we cannot change so easily. So one interesting example would be fossil fuels from a utilization point of view. So no matter how you burn fossil fuels, they still emit a lot of greenhouse gases. So this is a structural negative environmental impact. And on the flip side, non-structural impact are those kind of related to the extraction or production of commodities by companies that are producers or consumers. And this is often related to the practices, their operations. So these can be changed and improved. So in our analysis, in our assessment, we do put more weight on structural impact versus non-structural impact. One example, mining. Metals, often they are immediately associated with a lot of negative impact because oftentimes some companies, they have irresponsible mining practices that contribute to a lot of negative environmental impact and even social impact for displacement of communities. So, but then these can be changed. There are mining companies that are very responsibly mining, conduct their mining operations. So that's why, and on the flip side, these metals, a lot of them, They are branded as transition metals. They are essential ingredients and essential inputs to technologies and infrastructure for a green energy transition. So these enormous structural, positive environmental impact outweigh the non-structural impact. And one more point I want to highlight, the fund, it invests to get exposure to these commodities. They don't own the companies that are contributing these non-structural impacts. So we basically do this assessment for every single commodity within the fund. And even some of the commodities that have very substantial non-structural impact, such as, those that are not so easily changed. One example would be cocoa. We have excluded it because the child labor, forced labor issues is so entrenched throughout the supply chain, and this is something that we cannot bear within the fund. And on fossil fuels, this is often kind of being looked at. So the fund does not allow long position. Long position meaning kind of like the exposures that you would get from owning something. And that the fund does not allow owning the long position in fossil fuels because we don't want to promote positive dynamics, price dynamics for fossil fuels. But at the same time, we do allow short positions in fossil fuels. Why? Because fossil fuels, in reality, is still a good part of our everyday life, power a good part of our daily lives. So it is a very good indicator of the state of economy. So this is, the short positions is essential for the fund to get the necessary downside risk protection without encouraging positive price dynamics that promote fossil fuels. And so this is one example. And then secondly, is like the fund includes a lot of transition metals, most of them. And so like this approach, we try to be as comprehensive as possible. Not everyone will agree with it, but then if you agree with it, the fund is an excellent, excellent addition to overall portfolio because it really adds the diversification, adds the downside risk protection with the intent and also sustainability considerations within it. So I hope that answered the question.
Just add one thing to that. And within when we created the fund, we did back tests and simulations. And the way we structured the fossil fuels, where we only go short and don't go long, actually enhance performance versus going long and going short. And probably because in the long term, the real price of oil and energy is going down. It's through technology. So it doesn't pay to go long, it pays only to go short. And it's working out for clients and also serving our clients' needs.
Fantastic. Well, thank you. We'll leave it at that. I feel like that was very comprehensive. And we are a little over time now, so just to honor everyone's time, wanted to thank everyone who joined us online today. Thank you so much for being here, and particularly those of you who made your way downtown to join us in person. It was fantastic to see you. We will be, again, providing this as a recording. I'll ask that the people online, if you could stay on for just a few more seconds, we will have an automatic survey that you will be forwarded to. We would love to know your feedback. And for those of you in person, there are sheets on your tables where you can also provide feedback, and we would love your feedback as well. So thank you all so much for being here. Thank you to everyone who was involved, the amazing village that it took to put this on, and have a fantastic day, everyone. Thank you.